Most people watching this video are making a mistake with their money right now, not because they are not trying, not because they're not investing, but because they picked an ETF without ever asking the one question that actually matters. And by the time they figure it out, years from now, the damage is already done. Today we're talking about two of the most popular ETFs on the planet, VOO and SCHD. Millions of people hold one or both of these funds, but most of them have never sat down and honestly asked which one is actually right for my life, my age, and my goals. Growing a big number on a screen is being rich on paper. Getting paid every quarter without selling a single share, that's being wealthy in real life. Today we're going to talk about both. Before we get into the numbers, I am not a financial advisor and this is not financial advice. Always do your own research and speak with a qualified professional before making any investment decisions. Now let's get into it. VOO and SCHD are built on completely opposite philosophies, and most people never stop to think about what that means for their money. VOO tracks the S&P 500. It holds the 500 largest companies in America, weighted by size. The biggest companies get the biggest slice of your dollar. Right now, roughly 36% of every dollar you put into VOO goes into technology stocks. Nvidia, Apple, Microsoft, Amazon. When tech runs, VOO runs. When tech falls apart, your account feels every bit of it. SCHD takes a completely different approach. It holds just 100 companies, but every single one has to earn its place. 10 consecutive years of dividend payments, strong return on equity, healthy cash flow, solid dividend growth rate. Companies that stop meeting those standards, they get cut at the annual review. No exceptions. The result is a portfolio built on businesses that generate steady, growing cash. Names like Chevron, Coca-Cola, and PepsiCo. Boring on the surface, powerful underneath. These are not two flavors of the same fund. They are two completely different tools built for two completely different jobs. Let's start with the number VOO investors love to lead with. Over the last 10 years, VOO has compounded at roughly 15.1% per year. SCHD came in at around 12.8% annually over that same period. Both figures include dividends reinvested. On a $100,000 investment, that gap adds up to a meaningful difference in portfolio value. VOO pulls ahead by tens of thousands of dollars over a decade. VOO wins on total return. That is simply the truth. But here is the context that changes everything. VOO's dominance over the last decade was built almost entirely on one thing: the greatest technology bull run in stock market history. Nvidia alone returned thousands of percent. The mega-cap tech giants dragged the entire S&P 500 to heights that had nothing to do with the average American business. VOO was perfectly positioned to ride that wave because it holds all of it. SCHD holds none of those names. It was never designed to chase growth stocks. So yes, it trailed VOO during the biggest tech boom in history. That's not a flaw. That's exactly how it was built to behave. The question is, what happens when that tailwind stops? In 2022, the Federal Reserve raised interest rates at the fastest pace in 40 years. Growth stocks collapsed. Tech got crushed. The S&P 500 dropped 18.2% for the year. SCHD dropped 3.2%. Read that again. While VOO investors watched nearly a fifth of their portfolio value disappear, SCHD investors barely felt it. The defensive sectors SCHD holds, consumer staples, energy, healthcare, financials, do not fall the same way growth stocks do when economic pressure hits. And here is what makes 2022 remarkable beyond just the price difference. While SCHD's price held steady, its dividend grew 13.9% that year. The fund paid its investors more cash during one of the worst bear markets in recent history than it did the year before. It also raised its dividend through the pandemic in 2020. It has raised its payout every single year since its launch in 2011. 14 consecutive years without a single miss. That is what a quality income fund does. It does not just protect you from the fall, it keeps paying you while everyone else is panicking. History shows this pattern repeats. Every time the market rotates away from tech-driven growth, SCHD's defensive holdings absorb the shock, while VOO carries the full weight of the correction. Your job as an investor is to decide which of those two experiences you can actually afford, financially and emotionally. Now let's talk about income, because this is where SCHD completely separates itself. VOO currently yields around 1.1%. On a $100,000 portfolio, that's roughly $1,100 per year in dividends, about $92 a month deposited into your account. SCHD currently yields around 3.4%. That same $100,000 produces approximately $3,400 per year, about $283 a month, purely from dividend income. More than 3 times what VOO pays. But the yield today is only part of the story. The growth of that yield is where SCHD becomes extraordinary over time. Since launching in 2011, SCHD's annual payout has grown from $0.22 per share to over $1.05 today, a 10-year dividend growth rate of nearly 11% compounded annually. Investors who bought SCHD at launch are now collecting a yield on cost, meaning the yield based on their original purchase price of over 12%. Their original $10,000 investment now generates more than $1,200 per year in dividends alone, and that number keeps climbing every year without adding another dollar. VOO's dividend grows too, at roughly 6 to 8% annually, but starting from a 1.1% yield, the income never reaches the same destination. For anyone whose goal is to eventually live off their portfolio without selling shares, that compounding dividend growth is not a bonus feature. It is the entire point. Here is the question that settles everything. What does your money need to do for you right now? If you are in your 30s or early 40s, still employed, still adding money regularly, your portfolio's job is to grow as large as possible. You do not need income yet. VOO belongs at the center of your strategy. Time and compounding are your greatest assets. Let them work. If you're in your 50s or beyond and income is approaching, the math shifts completely. A 1.1% yield on $100,000 gives you $1,100 a year. A 3.4% yield on that same $100,000 gives you $3,400, and that number grows every single year as SCHD raises its dividend. That is a portfolio built to pay you. That is the difference between watching a number on a screen and actually living off your investments. If you're somewhere in between, a split makes real sense. Many investors run 60% VOO and 40% SCHD, gradually shifting the balance toward SCHD as retirement gets closer. You get the growth engine and the income cushion in the same portfolio. These two funds share almost no holdings. Their top 10 positions do not overlap at all. So combining them gives you genuine diversification, not just the appearance of it. The right answer is not VOO. It is not SCHD. It is whichever one or which combination matches what your life needs your money to do right now. One question for you, and I want you to answer it in the comments right now. Are you holding VOO, SCHD, or both? That is it. One answer. Drop it below. I read every single comment in this community, and I respond to everyone. If this video gave you clarity, subscribe to InvestED. Every week we break down the real numbers behind dividend investing, passive income, and index funds, the kind of content that actually helps you build wealth, not just talk about it. Smart investing, profitable results. See you in the next one.